In contrast, stocks with fancy names tend to be overhyped and are more likely to decline. He recommends investing in companies with mundane names that do boring but essential jobs, such as a company that manufactures bottle caps. These companies often fly under the radar of big investors and can present potential investment opportunities. Furthermore, Lynch advises investors to focus on companies with low growth rather than high growth industries. High growth industries are prone to increased competition, leading to price declines. Instead, he suggests investing in companies that make use of technology rather than investing directly in computer companies. By utilizing technology at lower prices, these companies can maintain profitability. Lynch also highlights the importance of looking for companies with a significant share in their stocks. Companies in which shareholders have faith and hold a substantial stake are often good investment options. Conversely, Lynch cautions against investing in stocks that are the talk of the town or companies promoted as the next big thing. These stocks tend to experience rapid price increases followed by significant losses. He advises avoiding stocks with inflated stories lacking substance. Additionally, Lynch advises against investing in companies with fancy names, as these names tend to attract attention without necessarily reflecting the company's potential for growth or profitability. In summary, this chapter provides guidance on investing in stocks by considering strategies for increasing earnings, focusing on stocks with dull names and low growth, identifying companies producing essential goods, and recognizing the significance of shareholder confidence. It also cautions against investing in overhyped stocks, companies promoted as the next big thing, and those with fancy names. By following these principles, investors can make more informed investment decisions. Earnings, 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 the 2-minute drill and getting the facts. Main idea. This chapter focuses on key indicators that can assist investors in making investment decisions. It highlights the significance of understanding earnings and assets in determining a company's value. The chapter also emphasizes the importance of gathering ground facts about the company before investing, particularly in relation to the 6 categories previously mentioned. Story. To make informed investment decisions, it is crucial to assess why a company will be more valuable in the future compared to the present. This assessment revolves around earnings and assets, as they influence the price investors are willing to pay for a stock. The price to earnings (P/E) ratio is a useful measure to evaluate whether a stock is overpriced, underpriced, or reasonably priced. Calculated by dividing the current stock price by the company's fiscal earnings before 12 months, the P/E ratio provides insights into valuation. Since it is challenging to predict a company's future earnings, it is important to focus on understanding how the company plans to increase its earnings. Regularly assessing the execution and effectiveness of these plans provides valuable information. Once the company's category and the pricing of the stock are determined, the next step involves gaining further knowledge about the company and its prospects for growth. For slow growth companies, it is important to examine if they consistently pay dividends and if their earnings are increasing. Additionally, it is crucial to evaluate whether the company continues to pay dividends during recessions. In the case of cyclical companies, recent sales trends should be considered. In asset play companies, it is necessary to assess the nature and value of the company's assets. Turnaround companies require scrutiny to determine if their earnings are improving and if their plans are yielding positive results. When investing in stalwart companies, the P/E ratio serves as a reliable indicator. For fast-growing companies, understanding how they can sustain their growth is essential. Contacting the company directly is advised for any questions or concerns. Companies generally strive to be honest with their investors, knowing that the truth will eventually be revealed in reports. As a shareholder, visiting the company's headquarters provides opportunities to meet representatives and develop valuable contacts. Additionally, visiting stores and experiencing the products firsthand, as well as engaging in conversations with product users, can provide insights into the company's market position. In summary, this chapter underscores the importance of earnings and assets in investment decisions. It highlights the significance of the P/E ratio, understanding a company's growth plans, and gathering ground facts about the company. By considering these factors, investors can make more informed choices and gain a deeper understanding of the companies they are investing in. Some famous numbers, rechecking the story and the final checklist. Main idea. This chapter discusses several key numbers and metrics that investors should consider before making investment decisions. These numbers provide factual information about the company's status and help determine its value. The chapter also provides a final checklist of tips and suggestions to conclude the investment process. Story. After conducting thorough research on the company, categorizing it, and assessing its earnings, there are still important tasks to complete before making an investment. This brings us to step 5, focusing on numbers. Numbers provide a more reliable representation of a company's true status and its position in the market. Here are some crucial numbers worth considering before investing. Percent of sales. The percentage of sales indicates the importance of a product within a company. Higher sales reflect greater significance. Analyzing this metric helps evaluate the company's revenue streams and the success of its products. 1. Price-earnings ratio, P/E ratio. The P/E ratio assists in determining whether a stock is overvalued, undervalued, or fairly valued. 1. It is calculated by dividing the current stock price by the company's fiscal earnings before 12 months. 1. Comparing the stock's P/E ratio to the industry average P/E ratio provides insights into its relative value. 1. A lower P/E ratio compared to the industry average may indicate an undervalued stock, while a higher P/E ratio suggests investors anticipate higher future earnings growth. 2. Cash position. The cash position represents the company's net cash per share. 2. It reveals the level of cash the company holds compared to its expenses and pending liabilities. 2. A stable cash position indicates the company's ability to meet its financial obligations without relying heavily on debt. 3. Debt factor. Assessing the company's debt-to-equity ratio helps determine its financial health. 3. If the company's debt exceeds its equity, it may be less favorable for investment. 3. Understanding the level of debt a company carries is crucial for evaluating its stability and potential bankruptcy risks. 4. Dividends. Stocks that consistently pay dividends, even during recessions, are generally preferred over those that do not. 4. Dividends can provide a reliable income stream for investors and indicate the company's financial strength. 5. Inventories. Monitoring the company's inventory levels is important. 5. If inventories continue to accumulate and surpass sales growth, it may indicate an issue. 5. This metric helps assess the company's ability to manage its supply chain efficiently. Regularly reviewing the company's position, reports, and ground facts is essential. This can involve visiting stores, talking to customers, and staying informed about market trends. By considering these numbers and maintaining an active understanding of the company, investors can make informed decisions. In conclusion, it is crucial to understand the type of companies you want to invest in and categorize them for easier analysis. Pay attention to small companies and avoid investing in stocks that are overly hyped. Companies without significant debt are generally more stable. Consider investing in companies that engage in share buybacks. Patience and thorough research are key components of successful investing. By following these guidelines and conducting comprehensive research, investors can make more informed decisions and increase their chances of achieving profitable outcomes. The long-term view. Main idea. This chapter focuses on designing a portfolio and identifying the best time to buy or sell shares. It emphasizes the importance of paying close attention to various metrics and factors to make informed investment decisions. While there is no single determining factor, careful analysis can help determine optimal buying or selling opportunities. Story. Step 6 of the investment process involves investing in the chosen stock. If the stock's P/E ratio is lower than the industry average, it is considered a positive sign. A high P/E ratio suggests potential future earnings growth but also indicates that the company is currently overvalued. Conversely, a low P/E ratio indicates that the company is performing well compared to its past performance, presenting an opportunity to buy undervalued shares. However, it is essential to consider other metrics such as inventories, cash flow, cash position, and debt factor to gain a comprehensive understanding of the company's overall picture. It is crucial to have realistic expectations regarding returns from the stock market. While it is possible to achieve a 30% return in some years, there is also a risk of losing 20% in others. Unrealistic expectations should be avoided. Diversification is beneficial, as owning more stocks increases the likelihood of one of them generating significant profits. Holding multiple stocks also provides flexibility to allocate funds between them. Spreading investments across different categories of stocks can help manage risk and potentially maximize gains. Different categories of stocks, such as slow growers, asset plays, cyclicals, and fast growers, have varying levels of risk and potential gains. Determining the best time to invest is subjective and depends on being convinced about the worthiness of the chosen stock. Notably, severe market declines often occur between October and December due to the holiday season. However, stocks should not be held indefinitely. If a company is not performing well or generating earnings, selling shares might be necessary. Step 8 involves selling shares, but there is no single formula to determine the timing. Guidelines for selling include selling a slow grower after a 30 to 50% appreciation, selling a stalwart when the P/A ratio is significantly beyond its normal range, selling a cyclical at the end of its cycle if issues arise, selling a fast grower when the P/A ratio becomes excessively high, selling a turnaround company after it has resolved its troubles, and holding on to asset plays as long as the company avoids accumulating debt. The market decline can present opportunities to invest in stocks, but caution should be exercised. Cheap stocks should not be purchased if their prospects are not promising. Furthermore, a poorly performing company can still face further decline. Maintaining an open mind to new ideas and opportunities is important. Conclusion. The book, One Up on Wall Street, offers insights into the stock market from expert investor Peter Lynch. It caters to both experts and amateurs, sharing Lynch's first-hand experiences and suggestions to guide readers in making sound investment decisions. The book provides tools for categorizing companies and helps readers determine suitable investments based on their personal financial status. By considering risk factors and following the advice presented in the book, readers can make informed investment choices and minimize the risk of significant losses.